Well, as we mentioned, the next big read on inflation is just around the corner here with December CPI. That's due out Thursday. But even if we see further easing on price pressures, will it make a difference to the Fed's policy? For more, let's bring in CNBC's Steve Leisman. Doesn't feel like it would, Steve.
Yeah, Melissa, another day and two more Fed officials making hawkish comments. San Francisco Fed President Mary Daly saying that both a 25 or a 50 could be on the table for the January-February meeting, and that it's too soon to declare victory and stop hiking rates. Raphael Bostic, the Atlanta Fed president, meanwhile said point blank the Fed is willing to overshoot no rate cuts through 2024 as far as he's concerned. He'll consider a 25 basis point hike depending upon what happens with the CPI on Thursday. Meanwhile, the data has been soft while the Fed rhetoric is hawkish. ISM services are contracting. December wage growth slowed. November was revised down sharply. And the 5-month annualized inflation rate running around 2.5%. Depends on how you count it. Could be lower than that. The price index of the ISM services index, that's the thing the Fed's all concerned about, back to where it was before the pandemic. It pretty much has round trip. To be sure, the unemployment rate did fall by 0.2, but the 2-year fell again today, and on Friday dropped with the jobs number and the ISM services number. That was the market's read of the data, if not the Fed's. The appearance, at least from their comments, is that Fed officials are not really data dependent, but instead they have a hot date with a 5% funds rate or higher. Charles Calamaris, he's a Columbia professor I talked to over the weekend. He said to me, what's strange at this moment when things are so ambiguous is for the Fed to be acting like their actions are so predictable. Fed may end up getting this right about inflation being persistent, or they could be making the same mistake they made last year when all of them, or nearly all of them, decided inflation was transitory. Melissa?
When the Fed comes out and speaks, I mean, first of all, they all sound the same, right? And we've been making that point for quite some time. They've all of a sudden gotten on the same page in terms of the script here. It sounds like they're trying to wrangle the markets. That's really what it seems like they're trying to do.
Oh, for sure.
The whole point of this whole thing is wrangling the markets.
Right, and it seems like the more they talk, the less control they have, Melissa. In terms of what's happened with the 2-year, look at what's happened with the 10-year. There's all of these things that they keep repeating. We have more work to do. The risk of doing too little is outweighed. Too little outweighs the risk of doing too much. They talk about the history lesson from the 70s. All these little components, and they all put them into their speeches and their commentaries and our interviews, and they're all saying the same thing. I'm just amazed, Melissa, that with the data the way it is, and by the way, with the market the way it is, market probabilities are spread out, but the Fed is pretty much uniform and monolithic in their outlook.
Steve, it's interesting. I'm glad you brought up the 70s. I've brought that up. People say it was much different that time. I get it, but I do think there's some sort of 1972, 73 analog parallel. But, you know, what I find, I think Jerome Powell in October of 2018, I know you remember this, when he was on sort of autopilot, reducing the balance sheet, raising rates, I think in his heart of hearts, he thought and knew that was the right thing. I think he got browbeat by the market into submission, you know, by December, by Christmas Eve of that year. Is there some semblance that, you know, he's now going to stick to his guns and he's not letting anybody dictate anything to him?
I think that's right. I mean, he's laid out this idea here, Guy, about the service sector and wages and the labor market. And I think sticking to his guns means he's not going to let up until he sees the labor market creating slack and wage gains coming down. Fact is, you did see some of it when you looked at the wage gains in the December payroll report, and also those downward revisions to November. But that's where he's at right now. He believes that the core service sector, ex-housing, is the area to look at. He believes that is driven by the tight labor market. And so no let up from the Fed until that particular area shows some improvement.
Hey, Steve, it's Karen. Thanks for being on. So what do you think he needs to see? You talked about labor, but what about in the CPI? What would he need to see to say, all right, we'll pause?
Well, there's an expectation. Okay, so he's divided up the inflation picture into 3 different components. The first is the goods sector. The second is the housing sector. And the third is the sector I just talked about with Guy, the core services ex-housing. Goods, he expects, and we already do see deflation in that. He expects housing to roll off in the coming months. It might be by the summer when the lower rates or rents that are out there in the economy start to filter into the index. There's an acknowledgement that that is lagging what's happening in the economy right now. But he's going to really want to see this service sector start to show less inflation. Whether or not that price index I showed you from ISM Services is a leading indicator here, it has gone the other way compared to what's happening in the CPI report. But that's what I would look at most importantly on Thursday, is that service sector area.
Steve, as always, thank you.
Pleasure.
Steve Leisman. If we're buying the rumor, what is selling the news in this scenario, Dan?
You know, it's back to this realization that the likelihood is that we're going to be this stagflationary environment. And I just heard a lot of like economics speak that is probably over my head in a way. And so we're seeing, you know, this kind of reversion to the mean on a lot of those inflationary things. But Guy's been saying this now for a while, is like, even if we do come in off of highs, like that CPI print, we're looking for a 6.1 CPI print after a 9.1 this past summer or whatever, it's still going to be high, and it's still going to weigh on growth. Right. And so I guess that, like, you know, it's just a tough situation here. And I think the most important takeaway that I have from that is that if the Fed is going to do what they did in 2021 and into 2022, and they're going to overstay their welcome, then they're going to stay. They're telling you they're going to stay tighter for longer, and that inflationary or stagflationary environment is just going to weigh on asset values, because that's the one thing that we saw. A lot of these major companies that, you know, we've seen come down a lot, we haven't even seen their estimates come down a lot by their own accord yet. It's been a valuation re-rating, and so I don't know why you would expect that to turn on a dime anytime soon, especially before I think equities start to discount a potential recession, and that's not going to happen at 3,800 in the S&P 500. It has to happen somewhere below those October lows.